FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz, and today is the 27th of August, 2018. We're coming at you from our new studio, moved a little further north in Palm Beach County. So we're going to get a lot of exciting changes coming, a lot of video that we're going to be producing as a result of our expanded quarters, and I think you're really going to appreciate it. As always, join the conversation, join the fun. Even if you're a troll, we welcome trolls. The email address is kl@kerrylutz.com. Somebody you've heard from a lot on the show, really in the know when it comes to the challenges that you're facing, that the economy's facing, that the country's facing with Social Security and Medicare. A new book coming up called Turning Financial Planning Right Side Up. Jeffrey Small, welcome back.
Hey, it's great to be here again, Kerry.
Hey, so we talked to you a little bit before, and we've talked about these issues before, and now you're actually going out and you've written a book about it.
Yeah, the book has really good traction. It's actually been, it was published on December 12th for release. It was an Amazon bestseller in its category for retirement planning, and it really speaks to people who are over 50 and teaches them how to modernize their money and beat the Wall Street bias and the media bias that's out there right now.
So you talk about that, and obviously Wall Street is created for the benefit of Wall Street, not necessarily, in fact, almost certainly not necessarily for you, the investor. And yet there are people who have who've made a small fortune who actually didn't start out with a big fortune. So how do you do it?
Well, I think, the whole key and the missing element that we don't see is, you have to invest to modernize your money to reflect the stage of the cycle and the markets and the economy that we're at. And the book gives you a really unique perspective on how to become financially literate enough to modernize your own money or to seek an advisor that can show you how to modernize your money. And so that's really how you have to do it. Or you have the HOPE strategy, which is how we normally do it, where most consumers, 50 plus, Generation Xers, millennials, whatever, they use the HOPE strategy, and HOPE should never be a tactic at the end of a stock market bull run like we have now.
Hey, well, we look back to our last occupant of the White House, Hope and Change, and we got very little of either, didn't we?
I like the pun. There's no doubt that hope is never a tactic, whether you're a president or whether you're an investor in the markets. You want something that's going to give you a better outcome than that.
Yeah, hope is a 4-letter word, right?
It is. HOPE, 1, 2, 3, 4.
Yeah. So don't rely on hope. You can hope for good times. It's okay to be optimistic, but you shouldn't be what they used to call a cockeyed optimist, who's just optimistic in the face of tremendous adversity and doesn't take any steps to prepare for it or to actually confront it head on. Instead, it just says, well, it's Candide and Zadig, like everything happens for the best. But when it comes to your financial planning, not everything that happens is the best.
No, if you utilize hope as a strategy with your money and you hope the market keeps going up, then what ends up happening, Kerry, is you end up becoming a victim. And, most folks today, they were snake bit and full of poison in 2008 and 2009, and not too far before that, in 2003, they were also pretty snake bit. So most folks have a very keen idea of what their statements look like. And we're having a lot of people coming into the office now that are really concerned about the current market levels, and for good reasons. I mean, I think we're looking at a market that's eerily similar to 2000. The price to sales ratio is twice what it was in 2000, and there's other weird commonalities. But instead of the technology sector being so overvalued in 2000, the whole market, the S&P 500's price to sales ratio, which is a much better metric than price to earnings because it can't be manipulated as much, is 2.63 times what it was in 2000. And so we're seeing valuations that are really kind of across the board. The entire market's been lifted up. And so the scariest part is that we've launched incredible forms of stimulus. The government spending $70 billion a month more than they collect. Hopefully, the tax cuts are another form of stimulus that they gave us, and hopefully the tax cuts will create enough economic inertia to recapture what we're spending, because we can't stay on this pace, presently spending more than we did, ironically, coincidentally, for whatever reason, under Obama. We're over $1 trillion a year than what we're spending more than what we're collecting, and that's going to have to stop. And what's weird, Kerry, is that we're doing this at the height of the stock market or economic peak. We've had a record market term right now. We're the longest market run in history. Even though the growth wasn't quite as good as it was in the 90s, it's still very close.
Mm-hmm. So one thing that I would argue, and I've heard others make similar argument, during the 8 years of Obama, we never really had an economic recovery. Yes, the stock market did phenomenally well. Wall Street, asset prices, huge inflation there. But Main Street, factories, et cetera, never experienced the fruits of that, never experienced economic recovery. So arguably under the first year, or give Trump the first 6 months, just not much you could do. But during the next year, or the last year of his presidency, we've seen an economic recovery take place for the first time since Bush 43 came into office.
Well, you're right, Kerry, and if that continues, this will be a record-setting bull market run. If we go into a protracted, long-term secular bull growth pattern, longer than the one we just went through, which is 10 years plus. Okay, we beat the 90s. Okay, if that keeps continuing without a correction, it'll be the first time in market history that we haven't had a third correction in a long-term secular bear pattern that started in 2000. So call Guinness. I hope it happens. I'm pro-growth. I want the economy to expand, but there's certain elements to everyday consumers they need to have to understand there are some trap doors here that could really hurt you with your money down the line. And the book identifies those, and it gives you the keys to understanding, so you can determine, what course you want for your money, as opposed to listening to the pundits on TV, which we want to avoid the bias and avoid the press. But you're right. We had the second best stock market in history under Obama, and the worst economic recovery in history. And those two things don't jive. That equals a contrived market.
Yeah, very much so. And the fact is, we've arguably, you could say, the entire financial markets have been contrived and manipulated since, we don't even need to go back to the beginning of time, but certainly during the Bush era and certainly during the Obama era, we just had all this liquidity going into the markets, just basically keeping them afloat and keeping them going higher. And so the question is, do we end with a whimper, or does it end with a bang?
Well, I think the answer is pretty easy. My book talks about what's driving the stock market, but the number one driver really is corporate stock buybacks. That's about 60% of all stock market activity. It's not Main Street buying stocks. It's big corporations like Apple that are buying back, tens of billions to hundreds of billions of dollars of their own shares. And I'm not going to name them all, but they're all doing it. And they've been doing it since March of 2010, where they've been buying $50 billion a month. But this year we're on pace to buy $1 trillion of stocks just by corporate America. And it really shouldn't be allowed. Nonetheless, during the second best bull market since March of 2009, Kerry, the average investors are in between 3% and 5%. Mm-hmm. And people ask, if the market's up 330% on the S&P and almost 600% on the NASDAQ since March of 2009, how come I'm not up? It's very rare that I meet anybody who's even doubled their money over that time frame. Most folks have averaged between 3% and 5%. And the reason is they're stuck in growth mutual funds, right. And those mutual funds aren't buying the right stocks to keep pace with the market. And so most individual investors in your listenership have dramatically underperformed the market. And so the book points that out and teaches them how to go back and calculate what their actual rate of return was and what it should be going forward. And so that's a bigger issue, I think, today than, when is the market going to pop? Because folks need to start circling the wagons now. I mean, I'm sounding off the alarm now about the markets to get out. The market is dramatically overpriced. And the next 25% upside in the market is not worth it if we go through a 35% correction. The problem is you don't know when the correction or the market drop will happen or how long it'll be. Like in February when the market dropped 9%, we're all looking around at each other saying, okay, here comes the correction. We're going to drop another 25% here. Here it comes. Well, it didn't drop at all.
Yeah.
It did a head fake. Ran flat for a couple of months, and then May came in as bullish, and we've been growing since then. So, the market's not a mystery. As long as there's a demand for stocks, people that want to buy, what's going to happen? Prices are going to go up.
Yeah. Yeah, supply and demand certainly is at the core of it, and who knows where all that demand's coming from, whether it's foreign central banks or just people worried about the euro, worried about the yuan, and the dollar, apparently the safest or the best looking horse in the glue factory, whatever the case might be. Flow of funds from overseas is a big aspect. This is the time of the market where I always think what Bernard Baruch said, which was, I got rich letting the other guy make the last 10%.
I like that. And I think that's where we are now. And the time to get out of the market is before the market drops. But where folks don't understand, and my book will help them understand, is if you get the next 25% upside in the market over the next 2 years, and then we go through the correction, it did not do you one bit of good when you start to measure the efficiency of your money. And so you're better off avoiding the down, dipping your toe back into the equity pool of the markets after the correction finally happens. But we don't know what's going to cause that. We don't know what the black swan is. Is there going to be one? We don't know if the market's just going to keep growing and these numbers are going to be good forever. So generally, economic cycle and the market cycle. So at some point, the market will have a pullback or will correct. We just don't know when.
Yeah, that's always the problem, right? We just don't know when. So what do you do here? You put everything into bonds, which looks like interest rates continue to go higher, might very well keep going higher, and then you're going to take a hit there. You put it into cash, and you get no return. And what's poor Joe Sixpack to do?
Well, individual bonds, if you can buy them, you have to have get a good relationship with an advisor. But there's still good bonds out there to buy that pay between 4% and 6% that are good quality companies that are going to be around with short durations of 4 to 7 years. I don't care what happens to rates. Rates are only going to go up for another 12 months anyway. Then they're going to flatten out. Then they're going to have to drop them back down because the economy is going to start to slow down. The problem with rates is the debt structure that we have now is so maxed out on the public and private side of the equation. If we look at the federal debt, the budget will double at the rate that we're spending on the servicing the debt from $415 billion to $830 billion by 2021 with just a 40 basis point upward move in rates. Terry, we are never going to see high rates. We are going to see rates go back down to nothing by probably the mid-2020. We're going to see rates drop dramatically because we can't afford to do that. They can't afford to service 13% of the federal budget and with servicing that debt, that we don't have the money. We'll have to make huge cuts in entitlements and huge cuts in defense, and they're not going to do that. So, we're coming to that epic saturation point in debt. Not to mention, consumer debt is also at an epic saturation point. So we've expanded the same debt monster the last 10 years to get us back into a higher asset price category in stocks and real estate for what they did in the 2000s. They just did it in a different way. Same style, different way.
Mm-hmm. So we're getting to that point, we're coming to the fork in the road, and you know what Yogi Berra used to say about that. When you come to a fork in the road, take it. And I guess we're going to take it.
Well, it's going to be very interesting unless the Trump tax plan makes North America the new China and companies start relocating here in droves, which is happening, by the way. They are relocating here in droves, and there's hundreds of billions of dollars a month of companies relocating here. If that continues, that might end up, no pun intended, trumping the downturn potential in the economy and might carry through into another long-term secular bull. We don't know. We've got to pay close attention, and we've got to modernize.
And really, so a lot's happening, though. The flow of funds into the U.S., that's not illusory. It really is happening, partly due to the euro instability and partly due to Trump's policies, right?
It's a direct correlation to Trump's policies. It would not be happening had we not done that. And Canada's a fine example. Their corporate tax structure is way worse than ours now. So a lot of companies are relocating, especially in the energy space, to the States. And so I see that happening. We've got lots of qualified workers here. It's a higher wage, but as the cost of energy goes up, it makes sense for companies to have more of a presence here or even be domiciled here.
But I thought Obama left a great economy for Trump, and he's just sitting back and just enjoying the fruits of Obama's hard labors.
Unfortunately, that's not the case. Nothing could be further from the truth. I think that's part of the fake news. Whenever and I do a lot of TV, Kerry. Well, whenever I get on TV, I try to right the ship so people actually know what's happening. But no, it had nothing to do with Obama. He didn't do anything for anybody, including people of ethnic backgrounds. He did nothing, which is the most disappointing part of his presidency. He had such a great chance to be inspiration. Instead, he created a nation of victims, unfortunately.
Yeah, well, the victimology, we have this structurally unemployed. And the other thing I wanted to discuss with you, Jeff, workforce participation rate. That's been going up gradually. It's certainly stabilized. It's not decreasing. By some measures, that's the most accurate picture of employment. And yet we've got these baby boomers retiring at 10,000 per day. That's the number they always throw out. I remember the greatest generation were retiring 10,000 a day. It's just a number that they throw out, absolutely meaningless. But a lot of people who maybe were out of the workforce and were considering going back in when the market, if and when the job market got better, now their investments, their home, all these asset values have gone up. And maybe they're thinking, I'm not going to re-enter the job force, the workforce. What's your take on labor force participation rates?
Well, we've had the first uptick in about 12 years in labor force participation, but that's really how you get the economy growing again. If there's going to be any hope for inflation, we have to expand the number of employees we have working. Now, you have a massive demographic shift in the free market space where we've got 15,000 people a day getting Social Security, 180,000 people leaving the private sector each month. And so, we're at a point now where the economy really can't expand unless we dramatically improve the job numbers, and we're going to contract. So what's also going to work against the market in the future years, and I talk a lot about this in the book, are the long-term secular patterns and demographics. And so that's a current, and I'll give you an example. By 2021, we hit a peak of folks that are turning 70 and a half. Well, when you turn 70 and a half, you have to take out money out of your IRAs. It's called a required distribution. Mm-hmm. There's about $11 trillion in IRAs. If the market stays at its current level at that point, that means that folks are going to pull out close to $400 billion just in required minimum distributions. That's a huge number. That's, almost as much as the corporate stock buyback. So we'll have a sucking sound of money coming out of the market, gradually bigger and bigger over time as people get older during that long-term course. So, I would encourage you to get my book. A terrible example of long-term secular demographics is what's happened in Japan, which is a tragedy.
Right.
But they're just not procreating over there. They're actually shrinking in a dramatic sense. They have been for years. And so we use them as an example in the book, and I cite many statistics on that. But it's definitely another way to develop another perspective on how to modernize your thinking and modernize your money and get away from hope as a tactic.
Yeah, and I think it's real important. Hope is not the way to manage a portfolio, a sound plan, a sound strategy. Look, every plan, lasts as long when you get in the ring till you get hit in the head, as Mike Tyson would say. But some plan is better than no plan. Can't deny that. Jeff, where is the best place to find you, to follow you on the web and read your work?
Well, the book has a website called financialplanningrightssideup.com. You can contact me through the book there. They have links direct to Amazon there as well. And if you want to talk to me about your money, I'm also available to do that. You can call me through the website, and my office will schedule a time for us to speak. And so those are the best ways to reach out, Kerry.
All right, excellent. It's always great talking to you, Jeff. It's nice to hear a mainstream financial person who's actually aware that markets can go down on occasion. All too many of the people, the financial people out there, it's always a good time to buy. It's never a good time to sell. And selling is when you're going to realize your profit. Buying is when you really make your profit, but selling is the only way to actually realize it. Anyway, Jeff, it's always great to have you on. Like I say, be a part of the show. Write us, email us, kl@kerrylutz.com. The Twitter feed is @KerryLutz. The Facebook page is Financial Survival Network. Jeff, good luck with the book. Talk to you again real soon.
Thanks, Kerry. Have a good day.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.